What's going on, everybody? All is well. So today we're gonna talk about the Fed rate cut that happened yesterday, and then we're gonna get right over into Lyft because they announced some amazing news on some stuff they're gonna have rolling out next year. But without further ado, let's get into it. So the Dow future gains 300 points as traders digest the Fed rate cut and outlook, and it's from CNBC. All right, let's see. All right, the stock future rose on Wednesday as investors continue to digest the latest uh, rate cut decision from the Federal Reserve. Futures tied to the Dow Jones Industrial Average climbed 333 points, or 0.7%. The S&P 500 futures traded higher by 0.9%, as did the Nasdaq 1000. The move follow a volatile day of trading Wednesday after the Fed, as anticipated, slashed its benchmark rate by a quarter percentage point, or 0.25%, or you could say 25 basis points. It means the same thing. Okay. All right, the Dow Jones Industrial Average was a lone gainer, rising 260.42 points, or 0.57%. Okay, we get it. All right. All right. So during the news conference following the decision, Fed Chairman Jerome Powell put a damper on investors' hopes uh, that the central bank would be on a lengthy rate cutting path this year, as he called the latest cut risk management. Okay. All right. In fact, policymakers are predicting two or more reductions this year, but just one in 2026, while traders have priced in 2 to 3 more cuts next year. All right, so we'll see how that one plays out. So, okay, the Fed's 25 basis point cut is a clear signal that the softening labor market and stubborn inflation have pushed policymakers to act, but gradually. Okay, this isn't a pivot; it's a measured step, says Gina Bolvin, president at Bolvin Wealth Management Group, said in a statement. For investors, this means modest rate relief, not fireworks. She added the Fed is walking a fine line, and upcoming inflation and job data will determine what's next. So they're just taking it case by case basis. So we'll see what happens at the next meeting. All right. So yeah, they cut in interest rates by 25 basis points. Now this means the rates that you would have gotten from a high yield savings account or a CD from the bank will be lowered, and also small cap companies are going to benefit from this interest rate cut because it's going to be cheaper to borrow money. Um, Also, the rates on your like credit card and personal loans, car notes is going to be slightly lowered. But yeah, like I said, they're taking it case by case, and we'll see what happens. All right, but next up, let's get into Lyft. In pre-market, Lyft is up $23.10, equivalent to a dollar, and well, now it's up 1% because it's in pre-market right now. It's fluctuating, but yeah. Anyway, they're up slightly in pre-market, and this is because Lyft has partnered with Waymo Taxi, which is owned by Google. So Lyft is partnering up with Google, and let's see what they got to say.
Almost 15% after the company announces a partnership with Waymo. It will bring fully autonomous rides starting in Nashville. Joining us now, first on CNBC, is the company's CEO, David Richter. David, good to have you. Starting in Nashville next year, is that the first market of what you expect will be many in terms of this potential for the partnership with Waymo?
I mean, I hope so, obviously. But look, this is just getting started. So last year, we really sat down and said, what is a great deal for Waymo, great for Lyft, and great for riders? And we came up with this demand generation plus fleet management construct. I think it's going to be great in Nashville, and obviously we set it up for the long term.
What is this construct you're talking about? Can you give us some sense as to what you mean when you string those words together?
Yeah, I know. It sounds like a lot of buzzwords, right? So on the demand generation side, that just basically means, look, we do 2 million rides a day across North America. A lot of those are in Nashville. And so we've got all the demand that a company like Waymo needs to keep their fleet utilized. And that's what they're going to want to do, right? They're going to want to have these self-driving cars always on the road. And we've integrated it, and this is our plan, very tightly into our marketplace in a way that makes sure that both companies always get kind of all the cars they need to satisfy the demand they've got. And then fleet management, it sounds kind of geeky, but it's really, who charges the car? Who keeps the car clean? Who makes sure the car is maintained? And we've been doing this for years, over a decade, with our subsidiary fleet management service called FlexDrive. So these two things together really make for what we think is going to be a really powerful partnership and kind of change the world of AVs.
Waymo has similar partnerships in place with other providers, including your competitor Uber. Is there a way that you feel like this differentiates in terms of what they're doing with Uber?
I do. The fleet management piece is unique to Lyft. So FlexDrive, which again we set up about a decade ago, has about 15,000 cars kind of on rent at any given point. And that kind of expertise, imagine having, thousands and thousands of cars. You have to understand where they are, when they've been last maintained, what they need to make sure that they're always available. We do that at an industry-leading level. Our cars are available about 90+% of the time, which again is industry-leading for fleet management. Again, I know it sounds kind of geeky, and when you see a self-driving car, around maybe a San Francisco or a Phoenix, you think it's just magic, that it just kind of magically takes care of itself, charges itself, and so forth. But that's not the case. So that's something that we do. We do it uniquely, and it's one of the things I think Waymo is very interested in. And then on the demand generation side, some of the other partnerships they have are of a very different type, and I'll let them speak to other partnerships that they've got. But we really like this model and think it sets us up well for not just now, but for the future.
Well, you just answered part of my question, which is, David, I get why you would want to work with Waymo. I mean, if the future of ride sharing is self-driving, but why would Waymo need a Lyft or even an Uber? Can't they just make an app and go out and do what you're doing?
So the thing is, when you think about rideshare, because you experience through the app, you think to yourself, well, this can't be that hard. But gosh, there is a lot of work that goes behind that app. Gosh, there's a lot of work. There's pricing. So again, 2 million rides a day. Every time someone opens our app, which is multiple millions beyond that, we've got to price it. We've got to estimate the ETA. We've got to make sure that the right car picks you up at the right time. We've got to do it for what we call standard, extra comfort, black, wait and save. It's quite complex. We've got to keep the car clean, or in some cases.
Plus, is also like brand recognition. Everybody knows Lyft. Everybody knows Uber. So Google won't become their competitor, try and compete with them. They'll just partner with them instead. It's much easier. They're already recognized. So Google won't be a competitor. They'll just partner with Lyft and Uber.
Cases the driver does themselves. We've got to deal with customer service. All of these things is real work, and it costs, frankly, billions of dollars over the last 12, 13 years that Lyft has been doing this. So if you're a company like Waymo, sure, you might want to do some of that yourself, and they are. They're experimenting in certain markets. But I think you also want to partner with people who have been doing it for years and years and years.
Exactly.
And I believe doing it the best in class, and figure out whether that model is maybe an even better way for you to monetize this asset, this huge amount of work you've done to create this amazing technology.
And what do investors need to know about how profitable and how much growth it's going to provide for you? Because you have turned around this company and you've been working a lot on profitability. So what does the Waymo partnership look like in terms of the economics for your business?
You know, I'll put it in the bigger context. We've always said that customer obsession is what drives profitable growth. And that's what you've seen over the last 2.5 years or so since I've been in the seat. Customer obsession means creating great products and services that your customers want. And so self-driving cars are amazing. They're safe. You know, they know the rules of the road. They tend to follow the rules of the road. They're very reliable. They're quiet. So at a time when you want that experience, we love having that. And what we see in markets where there are autonomous cars, because there are, you know, right now, we actually see those markets growing faster than a lot of the other markets we operate in. So I think from a growth perspective, it's only going to be positive. And then as you say, from cost, you know, of course, you've got lower insurance costs over time. You don't have to pay the drivers. Now, there are always trade-offs, right? There'll be other costs around maintenance and such. But we think it's going to be great for the industry because it'll grow it, but also grow it, you know, profitably.
Nice. So yeah, Lyft, I don't know, it's looking like a long-term play in my book. You know, I just might have to start a dollar cost average into the stock. You know, obviously I already have Leap's option on Lyft, but in terms of the stock of itself, I might add it to the portfolio as a long-term investment because I like what I'm hearing. You know, I don't know. I'll think about it. But yeah, that's it. Lyft continue to do its thing. Long term is looking good. Is looking good so far. But with that being said, thank you guys for watching. You guys be safe, and I'll catch you guys in the next one. All right, peace.